VF Corporation is at a 10-year low, down nearly 80%, trading at its 52-week low, and we do see an A grade on a valuation basis. On top of that, we see 1.8 million worth of insider buying just over the last 12 months. And in today's episode, we are going to understand if this company is incredibly undervalued and definitely a big, strong buy now. As always, we are going to do a deeper dive. We're going to look at their top line revenue growth year on year, as well as their bottom line net income. We're also going to look at the health of this company, their total cash versus their total debt, which is very important given they have recently had a dividend cut. We'll also look at their dividend safety, run through a lot of their metrics, free cash flow, ROIC, as well as some others. We're also going to take a look at some information from their latest earnings report as well. And as always, we will run them through the valuation model, getting to both our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and look towards Wall Street, who do see some nice upside over the next 12 months. On top of that, we are also going to put it into the discount and cash flow model with 3 different matrix. We have a low, medium, and high, so you can also understand where our future projections are coming from and see whether or not you agree or would increase or decrease it. So let's just jump into the historical performance. Now, we do note it is down around 79% over the last 10 years. Bear in mind, if you were to reinvest those dividends, it would be up slightly higher, but a very poor performance over the longer term. And over the last year, we do see it hammered down around negative 43%. When we take a look at it on a PE forward basis, we do see 11.62. Now, it was previously offering a yield of 6.2%. However, now after their dividend cut, it does trade for around 2.85%. So still a fairly healthy dividend, which we will take a closer look at. So first things first, we want to look at their growth on a top line revenue basis. Typically for a company that is more mature, more steady, 3 to 7% growth year on year. What we noticed, January 2015, 11.9 billion on the top line, and we can see in the more recent year, 11.6 billion. So realistically, it looks like very minimal movement over the last 10 years, but what we see is a lot of inconsistencies year on year, no real growth, and if we were to factor in inflation, then we would see a decreasing top line, something just to factor in. We then move on to their bottom line net income, and we do note it has gone from 1.1 billion in January 2015 to around 119 million. So in fact, whilst the top line has barely moved over the longer term, their net income, as we have seen here, has in fact decreased. So we do have a red flag indicator, something that we do need to factor in, and we will look towards that latest earnings report just to understand where the issues lie. Now, the company has already been hammered, so let's find out if there is value and there is undervaluation speaking right now. In terms of the health of the company, total cash versus total debt, 972 million sat on the balance sheet in 2015, 990 in their latest quarterly report. So not much difference, and we can see whilst there has been inconsistencies over the longer term, that cash position has remained fairly flat. When we compare this now to their total debt numerically and directionally, what we can in fact see is their total debt has gone up from 1.4 billion to 7.3. So with their cash remaining fairly stable, we in fact note their total debt has gone up. Now, that will put some strain on the dividend safety that we'll come on to, but given the fact they did have a massive 70% dividend cut, this could help alleviate a lot of stress on the balance sheet, which we can take a further glance at. Now, what we like to do, very quickly, look at their earnings over the last few quarters, see how they've performed, and what we in fact note, over the last 4 quarters, they've only beaten once, so a 25% track record, not looking great, and to be honest, when we do look at the quarters, we note the expectation for when they release earnings in a few weeks is negative 88% year on year. However, what we can in fact see is that it is looking like it will be increasing and improving over the next few quarters. We have 0.11% expected year on year for the first quarter in 2025, mid digits in quarter 2 2025, and Q3 double digit growth. So it does look like things are expected to improve, but as we can see, and one of the reasons why that in fact share price has taken a hit other than dividend safety, but their earnings track records has been very poor in relation to what analysts were targeting. Second thing to note then is the valuation grade. It gets an A, as we mentioned earlier, which is pretty decent. When we compare that, we can see their P on a non-GAAP basis just under 12. Sector median coming in a lot higher, 15.65. So they are lower by 25% than the sector. In terms of comparing on other valuation models, for those that do like to take a look, looking fairly decent as well. If you like to look at a price to cash flow basis as well, very, very strong A and an A- on the trailing 12 month, as well as a forward perspective respectively. So lots to like on a valuation side, but as always, it's not just about certain metrics. You do need to have your own investment thesis and always do your own due diligence. In terms of growth, not looking too great. They have an F, so pretty much one of the worst ratings you could get. On a year-on-year basis, negative 7.5, with the sector median coming in at low single digits. On a forward-looking basis, negative 4%. We have the sector at just under 4% as well. And in fact, again, on every single other metric, looking very poor. If not a D, we are looking at an F. The one thing that I do like to look at is essentially their growth on the earnings per share. In fact, it is meant to decrease, negative 4%, versus the sector, in fact, median of 11.5. So not great. Let's move on then to essentially the profitability. We do get a C+. Gross profit margin looking very strong, 52%, a lot higher than the sector median of 37%. Bottom line, now this is a worry, negative 7% on a trailing 12 months. They are in fact making a loss, a net loss on a trailing 12-month basis. Sector median coming in at 4.51. We do have the other metrics here. What is very solid though is their cash from operations on a trailing 12 months, 1.28 billion, whereas the sector median coming a lot lower at 282 million. Now, just to sum this up in conclusion, yes, we have 1 buy rating from Seeking Alpha, 2 hold ratings from Wall Street and Quant, and on a valuation perspective, an A rating, very good, growth, very poor at F, and profitability in the median at C+. So, again, do bear this all in mind into your own, not just in valuation thesis, but also into that margin of safety we will shortly come on to. Now, no surprises here, we will show this, but again, you should really understand the return that we're going to be seeing right now. Then the consumer discretionary, we're looking at others very similar. We have Columbia Sportswear, Burberry Group, Capri Holdings, and a few others. Now, over the last year, what we do note, again, this is total return, so this includes reinvesting those dividends. You would be down 41%, pretty much one of the worst in their competitors. When we expanded over the last 5 years, negative 83%, so very poor. And over the last 10 years, when we saw that you would be down negative 79% at the beginning just on the share price, even if you were to reinvest over the last 10 years, every single dividend, you would be down negative 72%. So something to consider, but what I would say, past performance is not an indicator of future performance. If you are very hopeful, if you do the research, if you look at the information and you are happy, it doesn't necessarily mean because they've been the worst performing, down 72%, this will be their future over the next 10 years as well. So let's move on to some insider buying now. As always, we believe insider buying is an extremely bullish signal. Management buy only if they believe the share price will go up. And we note 3 instances of insider buying of $1.8 million in total and 0.6% in terms of insider ownership. When we take a look in Q1, we have 1.2 million worth of buys. At Q4, we see 598,000. So very, very strong. A lot of buys just over the last few months. And when we take a look at who these buys were, well, we can see the director on the 12th of February buying over 11,000 shares for $200,000. We also have an insider on the 9th of February buy over 65,000 shares for over $15. As we can see, the share price is now lower, so you will be getting at a better price at over $1 million. And we also noticed some at the back end of 2023. So lots of bullish signals here purely based on the insider buying movement. But as always, whether or not you include it, the information is there to decide. We then take a look at institutional ownership, 86.84%, fairly high. We have 855 million worth of institutional outflow over the last 12 months. And we can see a fair amount more buying, 999 million over the exact same period. Now, when we look at it in the more recent quarter, we do note a little bit more selling than buying, 37 million versus 34. But over the last 3 quarters before that, we do see the opposite. We see a lot more buying than selling. So in terms of the more recent period, yes, more selling than buying by institutions. But over the last 12 months, we do note a little bit more buying than selling. Now, before we jump into the underlying metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below and you can start reading straight away. We would draw your attention to how to find undervalued stocks, as this is one that everyone asks in the comments. What are the websites you use? What are the resources? We explain it all here, all completely free. Now, we want to draw your attention to essentially their last investor presentation. Now, this is an infographic which they did release from their third quarter 2024. They're releasing their next quarter in a couple of weeks, so we can run through the latest information. First thing we see, $3 billion of revenue. We do notice it is down 16% from the same quarter last year. However, their gross margin is up slightly, their operating margin slightly down, and we do note here that their earnings per share is significantly down from the same quarter in FY23. Now, when we look at their brands, they have suffered across all of them. Vans, North Face, Timberland and Dickies quite significantly, double digits as well. But they are very positive when we do take a look at the note from the CEO. He does believe, as he says, this quarter marked the beginning of the next phase of their transformation plan. And they do believe that moving forward, this will essentially see the share price as well as the company rise in a more positive manner than it has historically done. In terms of looking then at the information, some interesting highlights to note here. In terms of revenue by region over the last quarter, in fact, everywhere down other than APAC, which is up, although marginally 3%. And when we look at their distribution channel, it is down significantly in the wholesale of negative 28%. Main thing that I wanted to point out from here, because we will be using this in the valuation method, is their free cash flow, the expectation to be around 600 million moving forwards. So fairly positive, because when we do take a look, we will have noticed that over the last year, in fact, they were free cash flow negative. Now, in terms of the metrics, want to point out their dividend safety score sits at 40 unsafe. They did have a fairly recent dividend cut of negative 70% in October, and market cap 5 billion, a mid-cap company. We also note, in fact, their dividend safety was essentially downgraded to unsafe March 28th, and we have here essentially saying that the unsafe rating suggests moderate to high risk of a dividend cut over a full economic cycle. Now, we can take a look, but previously it was sitting at 50, borderline safe. So let's dive into that information to see if we need to be worried. Key metrics from the last recession, well, they increased the dividend during the 07-09 crash. They had negative 6% sales in the recession, above average, as for the S&P it was negative 12, but they also marginally beat the S&P 500, negative 39, with the S&P negative 55. In terms of dividend growth then, as we've mentioned several times, dividend cut last year, 1% on average increase over the last 5 years. But over the last 20 years, if you are a holder, you would be up 10% year on year on the dividend. But let's be honest, pretty poor given the fact that the share price is down significantly over that period. In terms of dividend growth then, it is sitting at 0 years. So let's take a look at dividend yield theory. Now, we won't really talk too much about this because typically it does show a company is undervalued when the current yield sits above the 5-year average. However, given the fact they did have a massive dividend cut, this data will be skewed. What we can say though, the forward P sitting at 10.6 is lower than the 5-year average of 20.4 and lower than consumer discretionary sector P of 12.7. Just remember though, any one of these models, we don't look in isolation and we will conclude towards the end. Now, as always, we do draw your attention to the free cash flow payout over the earnings payout, as the earnings is susceptible to manipulation by management through accounting. One of the reasons being, if you were to look over the last 2 years before the dividend cut, you would have been happy on the earnings. It was below 100%. When you looked at the free cash flow, you would have noticed in 2022, 144%. That meant that essentially in 22, management paid out more in dividends than they generated in free cash flow, a massive red flag indicator. In more positive news, after the dividend cut, it is meant to sit around 20%, so it does look to be safe purely based on this information that we've seen so far. As always, you do want to invest in companies that increase their free cash flow year on year. What we do notice, there is a downtrend here. In fact, negative free cash flow, as I just mentioned, negative 2.36, in fact, in 2023. Although 2024 it is expected to flip positive, around 600 million in total, 1.79 per share. In terms of sales growth then, 3 to 7% as we mentioned earlier, but we can see for the majority of the last 10 years that top line has suffered. Their best year 2022 double digit 28%. We can see on a trailing 12-month basis negative 7%, and over the longer term just another format to what we've seen previously. Shares outstanding, now what we want to see is a lot of share buybacks returning excess cash to our pockets. And what we can see is, yes, they have reduced it, but very marginally, very slow and very inconsistent. Nonetheless, we can see they have done that, but a little bit too trivial to really talk too much. ROIC then, return on invested capital, 10% or more, just to give us faith that management are able to effectively allocate their capital. Now, it isn't the worst in 2023 at 9%. The only disappointment is it was fairly high at the beginning of the data, 2014, 2015, 2016. Since then, it has started to come down. Something to keep an eye on. As long as it is around the 9 to 10%, then that is okay. Anything where it does start to continue downtrending is something that we need to take a bit more seriously. Operating margin, as always, 12% or more. What we do know is some operational inefficiency. Their margins have decreased, as we did see in the infographic as well for Q3 2024. We do ideally want to see revenue increase, margin increase. However, we know the opposite for this company. On a free cash flow margin, very inconsistent, but more often than not, it is above that 5% minimum level. And on a trailing 12-month at 10%, that is looking positive. We just want to see some consistency. Now, in terms of the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, this signals both balance sheet strength as well as dividend safety. Below 3 is what we want to see, and these numbers for the first time viewers show essentially the number of years it would take the company to pay off all of their debt net of cash on hand. First thing we noticed, it has started to increase, 3.75 in 2023, 4.01 in 2024. One of the reasons why we see that downgrade to the dividend safety even after that dividend cut. This really needs to be under control. Yes, next year that essential free cash flow payout is around 20%, but unless this starts to come down a lot lower than it is currently, then that dividend could potentially be inbound for another dividend cut. Just something to think about and factor in for this next piece that we are doing now. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, as always, we do run through every single model. However, for VFC, we do know on a trailing 12-month basis, their earnings per share is negative, so this model is irrelevant, and that therefore makes these other models irrelevant given the fact that when we do look at the average PE and multiply by the EPS, it would bring back a negative return. Then when we take a look at the dividend discount model, given the fact they did have a very large dividend cut, again, this is a model that would be irrelevant. So we're using the only model that we see fit, the discounted cash flow model. Now we have the free cash flow over the last few years. Average growth rate, negative 55%, and we have started off 2024, as we saw, at 600 million, so hopefully they will achieve that. And we also note negative 722 was what they performed in 2023. So based on their management expectation, as we showed you earlier, we have gone from a low growth rate at 2%, as we can see here. Based on that, with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and get to an intrinsic value showing a small sign of overvaluation. Now bear in mind, this is with a growth rate of 2%, a value of around $11, so implied downside in fact of 11%. If you believe it should be higher, around 4%, what we can see here is an intrinsic value of just under $15, giving us implied upside of 18%. And if you believe actually it should be around 6%, that is way too low, then as you can see, $19 would be the intrinsic value, giving implied upside of 51%. Now bear in mind, you can play around with these numbers. It is fairly subjective on your own investment thesis, and you can grab a copy of this model to run your own numbers through to take essentially other companies in your portfolio or in your watch list through all the models to get your own intrinsic value. Today's episode, we will go for the medium range of 4% through to the next slide. Therefore, the intrinsic value in today's episode is purely just this model, as we mentioned earlier. So intrinsic value of around $15, the current price around $12.64. We use an MOS level of 10%. Remember, we only execute if it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for VFC, a 10% MOS level, as we can see here, acceptable by up to $13.46. 15% we can see $20.71. So right now it is trading around a 15% MOS level. For those looking at 20%, around $12, and for those looking at around 25%, $11.22. But as we mentioned, right now in today's episode, a 15% MOS level. In terms of Wall Street and their expected target, well, $16.19. They do believe upside of around 28%, and they believe the share price will be higher than the intrinsic value we have calculated, indicating it does look to be a buy. Having said all that, let us know your thoughts in the comments below. Is this one you are looking to buy? 15% MOS level. Is there some value after they have cut that dividend where they can hopefully look after their balance sheet, pay down a lot of the debt which they were paying out as dividends to shareholders? Or is this one that is a no-go? As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Let us know your thoughts below, and as always, we'll see you all on the next one.